Welcome guys and hello. Welcome to our third webinar. Nice to see you again and thank you for your comments. I appreciate it very much. This is Olga and CLIQ company. So it's our third webinar and the topic of webinar is technical analysis. Actually, there are two basic analyses that every trader is using, and we are going to talk about one and the simplest and the most easiest one. It's technical. So if you have some comments, please leave them during our webinar. We'll do our best to answer the questions and some ideas of yours. And of course, we'll be glad if you take some activity and take part in our webinar. So it's not a lecture, it's like communication. So let's continue. During this webinar, you will get to know about the most important and popular patterns that all the traders are using to actually identify the future price movement. Because technical analysis, it's a forecasting of the future financial price movement due to the past price movement. So you look at the charts, you examine the markets, you examine the price, and you understand how it will move in the future. It's very easy, but though it requires some techniques. So these techniques are special patterns that traders trying to identify in the market, on the chart, analyze them, and predict the future price movements. Let's talk about a little bit of basic of the history, how it appeared actually, what we now call a modern technical analysis. So the founder, maybe, we can call Charles Dow, because it's actually an American journalist and the founder of the company, Dow Jones and Company, who actually has written some very important postulates and theorems. And his writings, he was writing this piece of work for over several years actually, was taken, analyzed and put into practice by the modern traders. And the most important from all his theorem are three postulates. So we're going to talk about all of them. Postulate number one, the market discounts everything. Two, actually the price moves in trends. And three, the history tends to repeat itself. So what does it mean that the market discounts everything? Technical analysts, actually the people who are using only technical analysis in their trading, think that you don't need to actually take into account some other factors separately for analyzing the future price movement. You need just to look at the price because it reflects everything. Actually, it really is. For example, some events very important for the country, which currency you are trading. If they happen, the price will show it for sure, for 100%. For example, floods, so-called force majeure, fundamental events, news, elections, something like very important for the country. And let's take into account, let's regard one example. It was said that Great Britain is going to leave the Euro Union. Though it was only gossip, it's not a fact, actual fact, but Great Britain was affected with this news, with this factor. And actually it started to go down very extensively. So the smart traders actually opened the positions for sale. And you can see that these postulates really works. Really, the price describes and depicts and shows everything that happens within a country, sometimes within a world. Sure, some sad events work much better than the positive ones, but nevertheless, it's life, and we adjust into it. So use this postulate and be ready that if some event is happening, the price will show it. Second, the price moves in a trend. Once the trend is established, the technical analysts think that it's more likely to continue to move in the previous direction. Because keyword actually is established, because sometimes the periods of uncertainty, of stagnation of the price are happening in the markets, and market participants actually are not sure in which direction to trade. And when we see that the trend is going to move, we can be ready using this postulate that there will be probability of prolonged long-term strategies that are working are based on the tendency. Actually, the best strategy that are working and bring the most profit is also the strategy that are based on the tendency. On this postulate number 2, that price is moving in a trend, so you always need to follow the trend. But there are lots of traders actually who enter the market like contra trend, and also they get profit. So there are no rules for that. You can use any manner of trading, but the postulate is working. Price moves in a trend, so use it and use it wisely. If you open the position at the beginning of the trend and you actually exit the market in the end, your profit will be expansive. This is how it works. And postulate number 3, that history repeats itself. It's based on more psychological factor actually, because there is a repetitive situation. There are some repetitive situations in the market, and the market participants got used to behave, to act in the same way. So if this situation happens again, they more likely will do the same things that they did before. And on this base, on this postulate, there are a lot of historical levels, so-called historical levels or strong levels are formed, which also help us to trade and to understand how the market is going to move. For example, if this certain price was very high for the market and couldn't break through it, for some period of time it was trying, it was pushing, but didn't make it. So more likely it will not be able to do it in the future. So that's why the history repeats itself. I know now you understand the philosophy of technical analysis that lies behind the technical analysis. Let's get into explaining how it really works. So there are some certain patterns that most of the traders recognize or learn to recognize, as we do today, and try to use them for their benefits. And we will talk about the most important of them. For example, figure number 1 is double top and double bottom. Let's talk about double top. So you can see that the market is forming a double top, and one can be higher, one can be lower. It doesn't matter. It doesn't mean that they must be on the same level. And what we can see that the price was trying to actually break through these maximums, but it couldn't make it. So it comes back to the so-called neck level. And what happens next? You need to understand that all the patterns are divided into 2 big categories. The patterns of reversal of the trend and the patterns of continuation of the trend. So this is an example of the trend reversal pattern. So if it was upward trend, it's going to change its direction and go down. So be ready when you see double top to open position for sell. When the price breaks through the neck level. In this case, it's a line of support. So after that, we see the falling of the price. So it's high time to open sell position. How much profit are you expecting executing this pattern actually? As much as the lowest maximum. Don't take highs. Don't be greedy. Leave some tips. And there is a saying on the market, leave some tips to the market. It's better to take less, but in the future to have a successful trading. Next, the same, double bottom, on the contrary. So we have 2 minimums and 2 bottoms, and the price was trying to break through them, and it was unsuccessful. It comes back to the neck level, to the level of resistance in this case, and pushes up. So in this case, the trend will be upward. So you're ready to open buy position. And as much profit as the lowest maximum you can afford yourself. Next. Talking about double top, double bottom, I need to mention that there is also a triple top, triple bottom. And what is the difference between them, except for the two bottoms, three bottoms, two tops and three tops? It takes more time. For the double bottom, double top, you can use it in small time frames. But for the triple bottom, triple top, you need to use bigger time frames, because for the market, it takes more time to actually form them. And it's not very convenient, because I need to mention it, there are some patterns, but it's not very convenient in one point of view, because actually there is a misunderstanding. Sometimes market is forming two tops and you open position, but actually you can see that market will continue to make the third top. So you entered the market a little bit earlier. So use double top, it's more commonly used. Next, very important, and I know for sure that everybody knows it. It's head and shoulders because of the shampoo. It's easy to remember, actually. And what we see the market is forming three highs, for example, and one high is high, and that's why it's called head, and two highs are a little bit lower. They're called shoulders. And market is trying to break through these highs, but unsuccessfully. The trend is upward, for example, and this is also a pattern of chart or market reversal. And when the price forming shoulder, head and shoulder comes back to the neck level, in this case it's line of support, you open position. Which one? Let's see. If it was upward trend, you open position for sell. How much profit will you expect? As much as some traders take head, so as much as they can. My suggestion, take shoulder, maybe not the lowest, the highest, but take shoulder. It will be much easier for you. It's better to take less and to, in the future, to have a successful trading. There are some traders who they actually setting profit for the highs, for the level of the hand, and the market didn't actually get a few points and comes back. It's very sad. And we have inverse head and shoulders pattern. Works the same way, but it's not so popular. Actually, the head and shoulders is the first where we can meet in the market much more often. If it was downward trend, prepare for the buy position, because it's also a pattern of the trend reversal. We also have two shoulders and the head, and we are ready to open position for buy and to take profit of the size of the lower shoulder. As an example, next pattern that we are going to talk about is triangles. There are different types of triangles. We are going to talk about three of them, the most popular. First one is symmetrical triangle. Let's look at the slideshow. So when we see that two trend lines are converging toward each other, it means that the market is forming a period of stagnation. Actually, it's in the period of stagnation, and we can draw these trend lines, low maximums and high minimums, and we will receive a triangle in the end. It's a little bit confusing, but it happens most of the times, and you can use the triangles patterns on even very small time frames. Why it's confusing? Because you can see two arrows, actually, yes, because market can move in the different direction, can move up and move down. How we understand in which direction we should open a position, because this period of uncertainty is not the topic of our webinar, actually. We give simple answers and clear one. So when we see the breaking through that actually a price is breaking through the upper line. We open position for buy. If it was uptrend, it will be signal of a continuation of the trend. We don't have another example, but actually when we see the breaking out of bottom line, we will open position on sell. It will be, if the previous trend was upward, it will be the reversal of the trend. It's easy. Breakthrough up, we open buy. Breakthrough down, we open sell. Next, ascending triangle. Let's look at it. So the characteristic of this triangle is that the upper line is flat and the bottom line is actually ascending or a bit of sloping, upward sloping. That's why the triangle is called ascending. This is the also pattern, or on the contrary, almost certainly pattern of the trend reversal. So it was upward trend, be ready to sell. And how we see it. When we see that the market breaks through the bottom line, we open position for sell. How much profit? Use the wider side of the triangle. I use middle side. Next, descending. As you can see from the title, it works the same way as ascending, but on the contrary, the bottom line of support in this case is flat, and line of resistance, another trend line, is a little bit descending. And also this is an example of a pattern of the trend reversal. And so when you see the situation when there is a breakout of the upper line of resistance, you open position for buy, for example. Next, the most commonly used patterns and known by all the traders, these are flags and pennants. Let's look at flag. Okay, flag. The characteristic of the flag is that it forms kind of a channel, actually. The trend lines can be a little bit sloping, but they're not convergent as in a symmetrical triangle, as we remember. And of course, the market is also, this time, has the period of stagnation. But if you understand the market from the images, maybe, and from the physical point of view, you understand that market was going up, and in some way, somehow, sometime, it stopped, because it started to become weak. And this is a period of forming a flag when the market actually is breathing in and out. And the market needs to breathe in, breathe out, and continue to move, because this is an example of continuation of the trend. Continue to move in the previous direction. In our example, it's upward trend. So when we see that the market, the price break through the upper line of resistance, open position for buy, and profit as much as the wider part of the flag. Actually, you can take middle part as I do. Pennant. Pennant looks like symmetrical triangle. Yes, and it's also a characteristic of converging of the trend lines and the stagnation of the market or the price, or a short period of consolidation of market. You remember the example that I was saying, when the market participants are not actually sure in which direction to open trades. So this is a short period of consolidation. Market also breathe in, breathe out, and continues to move. In which direction? When we see, this is the pattern of continuation of the trend. When we see that market break through the bottom line, we open position for sell. We can take profit as much as the handle is, but I take as much as the wider part of this flag. So these are the most popular, the most interesting and commonly used patterns. For example, if it was upward trend and we see the forming of the flag again, we open position for buy, because this is, I will repeat, the pattern of continuation of the previous trend. And open position for buy as soon as the price will break through the line of resistance. And our time comes to an end, and I need to finish our webinar. If you have some questions, you can always consult us. You can always come to us, to our office, and see us face to face. And also you can use our site and live support. And of course, not to forget all the information that has been given to you. You can open a trade account or a demo account using our site and try to figure out where these patterns are actually, how they were working. And I'll give a piece of advice. If you're going to look for patterns like head and shoulders, double tops, double bottoms, go to higher time frames, because it needs more time for the market to form these patterns. And as for triangles and flags and pennants, you can use in little time frames. You will see lots of, I promise you, lots of examples of these patterns. So now you know how to use technical analysis. Actually, it's a part of technical analysis, which is called graphical analysis, these patterns, to open trades, how much profit to expect, in which direction the future price movement will go. And I wish you the best of luck, and I wish you a happy trading and high profits. It was Olga and CLIQ FX Company. Stay with us. Thank you so much. Bye-bye.